Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
Welcome to another edition of Talk Money. For those of you who might be joining us for the first time, allow me to introduce myself. My name is Jeffrey Shank, a chartered financial consultant and owner of Andover Advisory Group, a registered investment advisor. And for better than 25 years, I've provided effective financial advice to individuals and businesses. And thanks for tuning in. Our mission here is to provide you with information and tips, all designed to help improve your money IQ. Good morning, Lou. How are you this morning?
Good morning. I'm doing very well. How are you?
Very well, thank you. So we've got a lot of stuff going on today. I apologize for not having to be here last week. There was a death in the family. A very prominent local businessman. I don't know if you saw it, Lou. If you're from the Valley, you must have seen the obituary.
No.
Henry Tormeo passed away.
Yeah. Oh, I didn't know. Yeah.
Yeah. It was sad. Yeah. But he had quite the send off. I don't know if you saw it or heard about it.
No.
So he is the owner of Tormeo Industries, and so they had this funeral procession that was preceded by cement mixers and dump trucks, and
Nice.
it was absolutely incredible. So everybody there had a kind story about this gentleman. He's quite the person, and so we're all going to miss him. But this week here on the show, we want to just take a look at October. October's in the books, and I want to just take a look at some of the stock market averages and maybe some key economic indicators. Just kind of get a sense of where we're at right now, and maybe talk a little bit about where we might be headed for the rest of this year. And I guess we've got a couple of Talk Money tips today.
Oh, excellent.
We're going to expand. Usually we have one Talk Money tip of the week. Looks like we're going to have a couple Talk Money tips this week, including ownership of your employer stock ownership.
Yep.
And also what's called the No Surprises Act. Have you heard about the No Surprises Act, Lou?
No, it'll be a surprise to me.
Yeah, so we're going to talk about that as well. So a lot of stuff to do. I do have a slide. I don't know if you can see it. We can bring that up. Perfect. And so this is a snapshot of where we were on October 29th of last month.
Mm-hmm.
So just taking a look at the major stock market indexes, October proved to be one of the best months for stocks so far this year, with each of the benchmark indexes listed having solid gains.
Mm-hmm.
The S&P 500 had its best month since November of 2020. The NASDAQ, which is a index of a lot of technology stocks, so it's overweighted in technology stocks, and tends to be uh, the index that typically has the better growth performance. So if we're in a if we're in a market and if we're in a bull market, typically the Nasdaq, because it does have a lot of these technology companies which tend to grow a little bit faster, tends to perform a little bit better in that during a bull market. But it picked up over 7.25%. That's the largest monthly advance in more than a year.
Wow.
Strong third quarter corporate earnings helped ease investor concerns about inflation, supply chain bottlenecks, and labor shortages, and also some increase in coronavirus cases. And investors were a little worried that might actually put a dent in business, at least towards the end of this year. But apparently, they overcame those fears and put more money in the stock market, pushing the averages to an all-time high. If we take a look at the Dow, for example, that's a little bit better than its last highest close, as well as the Nasdaq and the S&P 500. So we're at record highs. The bull market continues, though.
Yeah.
And so far this year, it looks like all the Nasdaq and the S&P 500 anyway are above 20%.
Wow.
So far this year.
Yeah.
So
just continues. It's just amazing.
It is. And we'll talk a little bit about strategy in just a second. I just want to touch on a couple of other things here as well. Yields or interest rates, as measured by the U.S. Treasury, it started the year under 1% because of fears about slowdown as a result of coronavirus, right?
Right. Yep.
It got as high this year because of concerns about inflation of about 1.7%. And here in October, we're down below 1.6%. Now, this might not sound like a lot of change or big moves, but when you look at it relatively speaking, it is. These are some big moves in terms of overall yields. And if you take a look at what's happened with inflation, you think about what's going on in terms of monetary policy. You take a look at the growth rates of the economy. You would think that there would be more. You would think that yields would begin to accelerate higher.
Right.
But for some reason, there seems to be a little bit of a disconnect between what's actually happening in the bond market and what usually or typically would fuel higher yields. And so perhaps that's just a temporary situation, transitory, as they say, or maybe there's something else going on that we just don't know, or perhaps some of these things, at least from a bond investor's point of view, are simply temporary, and they're not really worried about it in the long run and haven't pushed yields up too much higher. So crude oil prices, that's another area that you would think certainly is a factor in terms of inflation, and that has jumped incredibly since the beginning of the year, almost doubling, right? So we're at 48 and a half at the beginning of this year, and now we're at $83 and potentially going higher. I don't know if you noticed the additional cost at the pump.
Yep. Yep.
But gasoline prices are at the highest rate they've been in years. And so, again, another factor that is fueling, pardon the pun, in inflation.
But that's only part of it at the pump, because raising the costs at the pump, raise the cost of almost everything in our society, because it has to be transported, it has to be heated, it has to be cooled. Fuel costs drive everything in this country.
Yeah, I mean, energy.
Yeah.
You could boil it down to simply energy cost, right? Where fossil fuels are the primary source of that energy. So you need energy, like you said, for transportation. You need energy to heat your home. You need energy to make stuff.
Yep.
And a lot of people don't realize that petrochemicals are one of the largest consumers of oil and natural gas. And so those are all.
I'm always concerned when administrations, and about half the time they say this, we have no control over energy prices. I always get discouraged when the White House tells me that.
Well, I mean, to some degree, that's true. Wouldn't you agree?
Well, okay, and there's a difference between correlation and causation, but I think if you adjusted the correlation of energy prices to the party that's in control of the White House, you might see an interesting correlation. Then you can make your own decisions from there.
You could,
Yeah.
except that what was going on a year and a half ago was a major shutdown of business worldwide, which reduced demand for energy to the nth degree, to the point where people would, according to futures prices, you were getting paid to take oil off of people's hands. That's what happened.
Yeah.
Right. That's where we were. It was a shock to the oil market. And so what was the reaction to that reduction in prices, Lo?
To that reduction in prices?
Yes.
Reaction from who?
Producers.
Oh, producers. Well, they shut down production.
Correct.
Yeah.
Right. Some of them went out of business.
Yep.
Others just shuttered operations because the demand wasn't there. There was no reason to pump it if you had to pay somebody to cart it away.
Right.
Right. And so once that happened, it reduced the energy or the oil output, oil and gas output. And so when demand started to pick up again, and that increase in demand was dramatic over the last year and a half, there wasn't enough production in order to keep up with the demand. And that was, again, worldwide. So that, I think, is probably the biggest factor that's affecting prices right now. Now, eventually, that supply will start to grow again and moderate those increase in prices. But when you think about it, if you don't have to produce more right now, you're probably not.
Yeah.
Right?
Yep.
And it's going to take a while for some of those producers who shut down operations to get restarted. And don't forget, a lot of these companies went out of business, so they're not going to be coming back online because they're no longer They're no longer alive. So I don't know if you can blame the White House necessarily for an increase in energy prices at this point in time. But perhaps there's something that somebody could point to that might indicate or might give me a good reason why some policy, let's say, that came out of the White House that would increase or reduce the flow, so to speak, of oil and gas. Perhaps I could be wrong. I could be totally wrong.
Well,
so
hopefully this lack of production ability is transitory.
Yeah. No, I believe that it is.
Yeah.
Reports are that the Saudis could increase production, but they're hesitating. And again, why would they at these prices if they don't have to?
Exactly. Yeah.
If they're not forced to, right? Yeah. So the stock market has performed well so far this fall, despite some of the headwinds. Specifically, GDP. I don't know if you saw the GDP number, but the second quarter GDP came in at 6.7%. Third quarter GDP only 2%, which was a big surprise.
Yeah.
Yeah. Jobs growth slowed also, although the number of unemployment claims decreased as well. And consumer price index rose 0.4%, and producer prices up 0.5% in the month of October. And so all those are headwinds that typically would be suggesting or indicating that stocks might be taking a hit, but they didn't.
Right.
There was a little bit of volatility beginning of the month in October, but that went away, and we're back to the races, right? One area where, if you thought there was some inflation on the horizon, you would expect the price to go up would be gold.
Yep.
But gold really hasn't done well at all. In fact, it's down year to date, almost 6%, which is surprising.
And that can that not be a tell, because some people, once they see problems in the market and the regular economy, tend to gravitate towards gold a little bit. So somebody knows something.
As a safe haven, you mean?
Yeah.
Yeah.
So there usually, isn't that kind of a leading indicator? You start to see a little bit of migration over to gold. The people in the know have seem to have some indication that the economy is about to stall.
Yeah, safer investments.
Yeah.
So gold would be one of those, and bonds would be another. So we're seeing possibly some of that movement into bonds through lower yields, but we haven't seen it in gold just yet.
Yep.
And perhaps that's because of the availability of cryptocurrency.
Yeah.
Although I wouldn't consider that a safe investment.
I know, but it's interesting that that market would impact the gold market pretty significantly. You would think they seem like brother and customers.
Are you talking about cryptocurrency?
Yeah.
Versus gold?
Yeah.
Yeah, except that gold is tangible and has utility.
Yeah.
Whereas crypto is neither.
I know.
It's not tangible.
Yeah.
Nor does it have utility.
Yeah.
Well, I guess to some degree it has some utility as a medium for financial transactions, but that would not, I don't think at this point, justify the prices for some cryptocurrencies. But that's a topic for another day.
Yep.
So all in all, markets continue to march forward. We're hitting all-time highs. Who knows what's going to happen for the rest of the year? But I've been saying it for a little bit. I've been saying it for a while now, that this would be a good time if you haven't taken a look at your overall portfolio, if you've had an exposure to the stock market, if that allocation to the stock market has outgrown itself, and you're exceeding your overall targets. This might be a good time to do some rebalancing, and maybe consider some alternative investments, because as inflation does stay with us, yields will probably follow, and that would be a negative factor for your bond investments. And so looking at other types of investments, alternative type of investments other than the traditional stock and bond investment, might be a good addition to your overall investment portfolio. And that's something that we could certainly talk to you about if you wanted to engage us. We do, I'll mention it again, we do offer an initial no-cost consultation where we can take a look at your overall investment portfolio, test it, see if the risk level is consistent with your attitude about overall risk, and perhaps suggest some changes if need be. And I guess that's pretty much where I wanted to update us on at this point.
Mm-hmm.
And we probably should probably should take a break at this point, Lou. And we're going to talk about employer stocks. Speaking of the stock market,
Yeah.
we're going to talk about employer stock. So, although it's not as popular as it was 20 years ago, people who work for big companies, public companies, are compensated through the company's stock. And that can become a problem at some point. And so I want to talk a little bit about that and a couple of tips in that regard as well. So let's take a break, Lou. And when we come back, we'll talk about your companies. If you work for a big company and they offer you compensation in employer stock, you'll definitely want to stay tuned for that.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. Hey, so if you work for a company, a public company, and in some cases, those companies will reward you, compensate you with their own stock instead of cash, right? There's a lot of ways, Lou, that can happen. It could be a matching contribution in your 401k plan. So instead of matching cash for your deferral into the 401k, they give you company stock. Or it could come in the form of just shares. So you've got a incentive program, and if you meet certain milestones, they give you stock.
Yep.
Or it could come in the form of stock options, where you get the right to buy shares, the company's shares, at a specific price, and where you're going to make your money. In all of those cases, is if the price rises, if the stock price goes up,
Right. Yeah.
Right. And in some cases, that can be much more valuable than just cash.
Right.
So it was more. Those types of programs were more popular 20 years ago. I actually have a chart that shows how company stock ownership has fallen over the years. So if you go back to 1999, right?
Yeah.
The average percentage of 401k assets invested in company stock, 19%.
Wow.
And today, 5% or less.
Yeah.
Yeah. Now, there's a lot of reasons for that. One would be maybe good sound advice from financial advisors who have been telling their clients, hey, look, you have too much money in the company stock. So I have a rule. My rule is you don't want to have any greater than 5% of a single security represented in your in your stock portfolio,
5%.
investment portfolio. 5%.
Mhm.
Right? You don't want to have more than 5%. Now, I have always allowed for a little bit of a deviation from that, up to maybe 10%, twice as much, if that single security was your own company stock.
Right. Yep.
Now, the reason for that, Lou, is because you're there every day.
Right.
Right? You kind of know what's going on. I'm not talking about insider information here. I'm just talking, just generally speaking, you have a good feel for the company's products and how they're performing and what the future might be. And so with that additional knowledge, we could stretch that a little bit. But I'd like to keep it below 10% and really closer to the 5%. So maybe some of this decrease in popularity or the amount amount of exposure to company stock and 401ks might be the result of companies not providing that stock match anymore. That could be part of it.
Mhm.
It probably is, because what was going on in 1999? What happened in that 1999 period?
.com bubble.
.com bust, right?
Yeah.
So if you were working for one of these technology companies
Sure.
and they were giving you stock, you're excited, right?
Right.
Give
Yeah.
me more. I want more. But then .com bust and your 401k get cut in half and became a 201k, and so
Is that taxable?
no tax consequence.
Yeah.
No,
Oh, yeah.
so you couldn't even benefit from the tax write-off because it was all done inside your 401k,
Right.
right? And so maybe people just weren't excited anymore about the owning company stock, and so that essentially what the data is showing us is that the use anyway of company stock inside retirement accounts has fallen. But I've also, based on my experience, I've noticed that certainly stock options are a thing of the past. A lot of companies, unless it's a startup, most companies are not offering stock options because that got to be a problem.
Sure.
And now what they're doing is typically it's an RSU, which stands for restricted stock unit. And so they're actually giving you stock instead of options to buy stock. They just give you the stock.
Yeah.
And again, in lieu of compensation. So the value of the stock that you get is essentially equal to the cash value of the compensation that they want to provide. But where you can make some money is in terms of the growth of that of those stock units, right?
Right. Yep.
Over time, the growth in the value of those stock units. And so there's a couple of things that you want to consider. First of all, if you have company stock being matched in your 401k, or you have restricted stock units or even stock options, you want to make sure that the value does not overtake or become too large a percentage of your overall investment strategy. And the reason is pretty simple. What happens if there's a bad headline?
Yep.
What happens if the company reports a bad quarter? Or what happens if there's something goes on and the stock blows up? You don't want your entire retirement to be dependent on one
Right.
issue, one investment. That's the most important consideration here. And so it's always a good idea to pare that back. The other thing that you want to consider is, if, let's say that you are close to retirement and you do have a large exposure, a large ownership interest in your company stock, there's a tax rule that allows you to, if the stock is in your 401k, this is specific to a qualified plan, right? So if it's in your 401k or it's a stock ownership plan, qualified stock ownership plan, there is a rule that allows you to take the money out of that retirement plan on a tax favored basis. They call it net unrealized appreciation, NUA for short, right?
Yep.
And so the stock goes into your account. You own it 20 years ago,
Right.
right? Presumably, the price today is much higher than it was when it went into your account.
Right.
So you have some appreciation, but at present, it's unrealized, right?
Yes.
So the stock went from 10 to now 100. So you've
Right.
got $90 of unrealized appreciation in that position, right?
Yes.
So typically, if it was outside of a retirement account, that would be considered a capital gain as long as you owned it or a long-term capital gain as long as you owned it for at least a year. And you would be taxed at capital gains rates.
Mm-hmm.
But inside a retirement account, that's not true, except that there is a special rule that allows you to capture that net unrealized appreciation and pay capital gains rates on it. That's the NUA strategy. So what
that
you do
happens within the retirement account, or
no,
Okay.
it happens when you make a distribution.
I
So
see.
here's what happens. You take a lump sum distribution and you distribute the stock in kind. You don't sell it before you make the distribution. You distribute it in kind. And when it comes out, it is taxed at the original cost when it went into your account.
I see.
$10 a share instead of $100 a share. And so you pay ordinary income taxes because that's the way retirement plans work. You pay ordinary income taxes on that deferred contribution to your retirement account.
Right.
But then when you sell the stock, subsequently sell the stock because you took it in kind, so you own it now. You don't have to sell it right away. You can wait. But that net unrealized appreciation at $90 a share, when you do sell the stock, and you don't have to sell it all at once, you can sell it incrementally, is taxed at capital gains rates. That can be a huge tax savings. Because if you sell it inside the 401k and then you start making distributions where you're taxed at ordinary income rates, which are higher, at least
Right.
for now. We don't
Yes.
know. We don't know. We don't know what might happen
Yeah. Right.
in the future. But at least for now, capital gains rates are lower than ordinary income rates. So this is a huge opportunity for people that do work for companies that have been putting stock away in their retirement account, and it has appreciated in value. And that's one of the things that we do anytime we work with a client. We make sure that we know what the original cost was for that stock inside their 401k plan. And it used to be, Lou, that you had to really dig to get that information. In fact, call the company and have them
Right.
do the research. Now, typically it's available online because they get so many requests and they realize how valuable this is that they just started making that information available right in your dashboard.
So when you take this distribution,
Yes.
and you are taxed the capital gains rate on the difference from the cost of it when it went in to the current cost of it, are you taxed at the
When
time
you
you do the distribution?
No,
When you
only
sell it?
when you subsequently sell it,
Oh, I see. Okay. Because I was
Which
wondering
could
what
be
happens if you
20
did
years
that-
from now.
Right. Yeah.
which could be 20 years from now. And by the way, if you never sell it, at least under current rules, your heirs would get a step up in basis, and nobody would pay the taxes on that appreciation.
Interesting.
Yep.
So that gives you total control over the amount of taxes that you, how
Yeah.
big a taxable event it is,
Right. Exactly.
Yeah.
Yep.
and when those
and-
taxes land.
And when they're paid. Yeah. Exactly.
Yeah.
Yep.
Fascinating. Yeah.
Now, so you can't just do this in isolation. It has to be part of a lump sum distribution. You have to recognize the value that you're distributing of that stock when it was put into the plan. But if you compare that to paying ordinary income taxes on the entire value, including the appreciation, it can be a significant tax savings.
Same rules on distribution. Has to be a qualified distribution in terms of age and reason and all that.
Correct. And
Yeah.
typically is upon termination or retirement.
Yep.
Yep.
Oh, termination, regardless of age?
Correct.
Yeah.
You don't have to be right. Yeah. Well, keep in mind if you're under age 59 and a half or under age 55 on a qualified plan, typically, you would pay penalties on
Right.
that. You would pay the 10% excise tax on the value that you're distributing equal to the cost.
Right.
Yeah. I probably should have put together an example. Maybe we'll do that another show. We'll
No,
do
you
an
were
example.
actually clear. You're so clear, I actually understand it.
Okay, good. Good.
Yeah.
So here's another tip. Okay, this applies to company stock. And remember, I mentioned stock options and restricted stock units. Basically, you're getting stock of the company.
Yep.
A lot of times, when you get that compensation in the form of stock, either options or restricted stock units, a lot of times there's little value there, and what you're getting is an incentive to help to grow the company and improve that value. And it can be a really nice incentive, and it can be very profitable, especially if you're with a small company that's growing, right? Or that may eventually go public.
Right.
So here's the problem. The problem is that you're not taxed on property that you're getting that you're being compensated. You're not taxed on that property if there is a substantial risk of forfeiture. So let's say that you get the stock, but you have to. It's not fully vested, and you have to be there for another 5 years before it has you can actually do anything with it.
Right.
Right. And if you leave, then you lose it. So if you leave before that 5 years is up, you lose it.
Right.
That's what they call a substantial risk of forfeiture. So under those circumstances, when you are compensated with that stock option, that restricted stock unit, you're not actually taxed.
Mhm.
So it just sits there, waiting for some event,
Right.
and that's when you get taxed. But here's the thing: you get taxed at ordinary income rates, and it's also considered. It's also subject to Social Security and Medicare taxes as well.
Yeah.
Yes, and so here's another tip. You can make an election when that stock is given to you as compensation, even though you wouldn't ordinarily be taxed. You can actually tell the IRS, "I want to be taxed today."
Okay. Yeah. I can see
And
that would make sense in situations. Sure.
especially if the value is a penny, and you're
Yep.
getting 10,000 shares at a penny, right?
Yep.
What are we talking about? I didn't do the math. Is that $100?
Maybe. Yeah. Don't ask me to do the math, but that's a lot cheaper than it will be when it vests 5 years from now, 6 years ago.
Exactly.
Yeah.
And because you did that, and by the way, this has to be done in a timely fashion. You have to do it within a certain time period of actually being granted those options or those restricted stock units. There is a risk that there could be no value in the future, so you chose to be taxed, and there's no value later on, and so you pay the tax for no good reason, right? So there is a little risk, but you make that election in a timely fashion, and then when eventually it does become fully vested, it's considered a capital gain and not ordinary income. So you tax at capital gains rates.
Yeah. Yes. So much to be considered here. I want to go back to the original piece and
Sure.
ask you about the distribution of the company stock.
Yes.
The idea is to turn it into a capital gains tax event as opposed to
Correct.
an income tax event.
Right.
And almost everyone who has company stock should be looking into this. Do you have to do it in a lump sum, or can you do it in increments throughout your retirement, for example? In other words, whenever you withdraw from those company stocks, can you do it in this manner, or are you limited to one transaction?
So in order to take advantage of the NUA provisions,
Mhm.
there has to be a lump sum distribution of the value of your account.
So you can't take 50% of the stocks out and do this with it. You have to take the entirety of those stocks out.
As I understand it, no. But Lou, you're only taxed on the original cost of that stock. And now, because it was distributed in kind, you actually have the shares. Now you can incrementally, systematically liquidate over time during
I see.
retirement.
Yep.
You don't have to sell it all. You don't have to then sell it all at once and then have all of the capital gains
Right.
taxed in a single year.
Just has to be
You can
taken out of the
spread that
retirement
out.
account. Yeah.
Correct. You can spread that out. Yeah.
So everyone who has
I
company
think that
stock,
might have been your question.
that is my question. So anyone who has company stock heading into retirement has to be fully vested in this program and understand how it works.
Correct.
Yeah.
Exactly. And here's the thing: before you make a distribution, if you own company stock, you really need to evaluate, because it may not work for you. It works for the individual that has significant appreciation in that stock from when it went into the account.
Right.
If there is no significant appreciation, then it doesn't make any sense. And just because there's appreciation doesn't make it make sense.
Right.
It depends on how much appreciation there is. That determines how much of a tax savings would be involved.
But what's the downside? I mean, even if there's limited appreciation,
What's the downside?
yeah,
Because you have to take all the stock out in that year, so you're taxed on all of the cost
see. Okay.
all at once.
All right.
So if you're not saving a lot in capital gains later on, why would you do that?
right. You're accelerating the
have
tax hit. Yeah.
Yeah. So look,
Yeah.
so you really have to analyze it and evaluate it to make sure that it's right for you. That's my point.
Yep.
NUA.
Do you know anybody who can do that for me?
Yeah, I know at least one person
Yeah.
that could help you out. Yeah. So there's something else that, if you have that situation where you have some employer stock and you're trying to figure out what's the best way to handle it both now and in your retirement. That's a great discussion that we could have during our initial consultation. And as you can see, we have the technology to do that virtually. So we could do a Zoom. We could do a Zoom call.
Yep.
Which I do a lot on my initial interviews, though.
Oh, Zoom's still a big part of it?
Yeah, well, it's certainly a lot easier.
Yeah.
Especially if a husband and wife are they're both employed and they're busy during the day. Now that they're back to work in person, it makes it easier for a late or an evening meeting.
I'm guessing it's more productive too, in that the couple or the person has access to their records and access to
Right.
information that if
Yeah.
they come into the office and did you bring your tax return from 2 years ago? No, I didn't. Yeah. That type of thing.
Right.
Yeah.
So they can go over to the file cabinet, pull it out, or they can go online and pull up their 401k account, and we can take a look at it. This would be a perfect example of that, where hey, do you have any company stock? Oh, yeah, we do. What's the cost? I don't know. Well, log into your account. Let's take a look.
I was going to say, many clients who have file cabinets at home? I mean, I know you do, but I don't know how many of your clients do.
Yeah, it's less and less common. Let's put it that way.
Yeah, but being able to access that information just makes the whole meeting that much more efficient, I would think.
Yes, it does. I think so too. And again, it makes it more convenient too, especially that first interview. I'm not saying that we would, there are some cases where I've only met clients virtually at
Sure.
this point.
Yeah.
And you know what? If it wasn't for coronavirus, I don't think the technology would be adequate to really do that.
No, isn't that interesting? Because
Yeah.
we just talk about economics in the market and how
Yeah.
Corona changed the market, and these
Yeah.
technologies just accelerated, and it's changed business. The whole Corona episode has changed the way business is run
It really has.
in a very substantial way.
Yeah. Yeah. So give us a call. We'd be glad to set something up if you want to kind of get an idea of how we might be able to help you out. And again, there's no cost, there's no obligation. That's just a meeting just to find out a little bit about what your situation is, tell you how we work and what we do, and see if it makes sense for us to work together.
But it's not going to be just a orientation either, or talking about how you two might relate. You can actually talk about a specific issue and get an answer to it.
Correct.
Yeah.
Yeah, absolutely. Yeah. No, in other words, you'll get value out of that meeting.
Yep.
In practically every situation, whether or not you actually become a client.
Excellent. Why would you not take advantage of that?
I don't know. Hey, so we actually have this week's Talk Money tip. Although, like I said, when I was reading the article on company stock ownership, I started thinking about those situations that come up, and less common today, but still there are people that do get stock as compensation. But I wanted to go over those two opportunities, tax savings opportunities.
You started to go down the road, and I was gonna see if you finished up on it, where that diminishment of the percentage of stock in your own company that people have nowadays, going from, I forget what the initial was,
19 to about 5%. Yeah.
Do you think some of that's because people are smart enough to redistribute some of that, as opposed to going into double-digit allocations of their own company stock?
No, actually, I think that's one of the things that I mentioned, is that I think a lot of that has to do with
being advised to keep
being
those
advised.
percentages down.
Probably in most cases, Lou, being advised as opposed to taking it upon themselves to reduce it.
Yeah, because you shouldn't have 19% of anything.
Yeah, so I've told the story in the past. I won't get into great detail, but I had this client that I met many years ago. And he had this huge position in this company stock, and I advised him to reduce it. Again, my 10% rule, right? And he chose not to, thinking that the price was it just fallen. It was going to go back up again. And then we had our annual review, and the price had gone down even further than the last time we had spoken. And I had still a big position, still too much. And then he declined to take action, and next year the same thing. Price was even lower, and he was trying to hold on to it. Finally, one year the price just got to the point where he threw in the towel and
painful.
Yeah, sold it, and eventually the company went bankrupt.
Yeah.
Yeah,
Well,
it's a good thing he sold it.
Some of it, yeah.
Salvaged some of it, but it was a fraction of what it was when we first met. So I think
behavioral finance, right? As that loss gets more and more, you get more reluctant to institutionalize that loss. And
that's exactly right. That's exactly what happened. Yeah. And finally, he finally gave in and sold what he had, and luckily he did. He got 10 times more value because the company filed for bankruptcy, reorganization. They still exist today, but the common shareholders were essentially handed a piece of paper that was worthless, and so that can happen. So
he works in the company, though. Should have known.
It was funny, and I won't mention exactly what happened, but
although we know the hierarchy of companies, and information doesn't always get down the tree.
Well, this was pretty obvious, but so for the first few years, so the first few years that we were talking about this, it was just because my recommendation was not about the company itself, but just because it was too large a position.
Yeah.
But then so we got together on one annual review, and finally I started asking questions about the company. He knew the answers. He could see the writing on the wall.
Yeah.
Yet he was still reluctant to sell. So anyway.
Another reflection in the changing of technology.
Yeah. So Lou, the No Surprise Act. Big surprise. So we're gonna talk about that, and a tip, I guess, as part of the No Surprise Act. So we'll take a quick break, and when we come back, we'll try to squeeze that in. We'll be right back. Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life.
so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Hey, welcome back. So this week's Talk Money tip is all about the No Surprise Act. And the No Surprise Act has to do with medical bills. And I do have a graphic, though, if you could throw it up there, that illustrates the concern that consumers have about certain types of costs and the ability or the inability to pay those costs. As you can see, one of the biggest concerns that people have, the biggest fears they have regarding surprise expenses is unexpected medical bills.
Right.
Apparently, food is. Although I'm kind of surprised that a third of respondents said that they are worried about being able to pay for food.
Well, you're only surprised because you don't go to the grocery store. I don't know when this was taken, but if you went,
2020
now, yeah,
2020.
Yeah.
I don't know. It just seems like a third, but anyway. So, but unexpected medical bills tops the list, right?
Mhm.
And so, the No Surprise Act, which was part of an omnibus spending bill in 2020,
Mhm.
It had to deal with those situations where, you know how these managed care companies, right? If you go to the providers, the doctors and hospitals that are in the network, you go in network, right?
Right.
You
Yep.
get the best possible benefit. Even though you might have copays, you might have deductibles. As long as you're going in network, you know you're getting the best reimbursement or the lowest cost to you, right?
Yep.
And then when you go out of network, well, you have to pay more.
Yeah, it's the Wild
In some
West.
cases, you have to pay it all
Yeah.
because they're just not covered at all,
Mhm.
right? And so you have that situation where you need emergency medical treatment, and you go to the nearest hospital, right? You get picked up by the ambulance, and they're gonna take you to where
Right.
you're gonna get the best possible care, right?
Yes.
So what
Yeah.
if that's out of network? What happens?
Then you're in trouble.
You get what they call a balanced bill.
Yeah.
So you get a bill that says, "Hey, I know you paid your deductible. I know you paid your co-insurance, but geez, you know that procedure you had that saved your life?
Yeah.
Well, it wasn't one of our hospitals.
Yeah, you should have gone 40 more
You
miles
should
and
have
got to
got,
one of
yeah,
our
you
doctors.
should have, yeah, you should."
Yeah. Yeah.
So what the No Surprise Act does is it eliminates, under certain circumstances, that the ability of the health insurance company to balance bill you for that emergency situation. And in fact, the only way they can balance bill you for out of network coverage now is if they are actually providing you certain disclosures, and they get in writing from you that you're choosing to go out of network.
Right.
That's the only way they can balance bill you. If they're not doing that, they can't do it. So there's no more surprises. The No Surprise Act.
So there's basically no more out of network.
No.
Yeah.
No,
Yeah.
if you choose, no, you can still choose to go out of network, but under an emergency situation,
Right.
they have to cover you at
Right.
in network. And let me just say that there are plenty of plans out there that take that into consideration.
Sure.
They realize it was an emergency situation, but I know many times where my clients have got this bill because they were out of network and they had no control at all.
Yeah.
That's the bottom line. If you
Yeah.
have no control, then if you have no way of making that decision, how
I
can
mean,
they?
if you're traveling, if you're in Maine or whatever, sometimes
And it's an emergency.
Yeah, it's an emergency, right? Yeah,
It's an emergency. I mean, if you're making a choice because you got the sniffles
yeah,
to go to a doctor who's out of network because you're traveling or for whatever reason, well, then you deserve to get balanced billed, I think.
yeah.
But so no longer, if it's outside your control, can they just send you a bill? And generally speaking, they really need to get documentation that you're aware that you are out of network and you're choosing to use that doctor or hospital. That way they can actually balance bill you. So that's this week's Talk Money tip. Keep that in mind.
Excellent. It's an excellent bill, which is a surprise.
Many surprises in the no surprise
That's
in the
great.
No Surprise Act.
Yeah.
All right, great. So hey, I think that's just about the end of our time today. Thanks for joining me, and we'll be back next week, same time here on Talk Money. In the meantime, remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.